Welcome to another Southbank Investment Daily Bulletin. Well, let's look at the FTSE 100 because prices right now are pretty much where they were in 2018. And obviously, there's been a lot of enthusiasm because we're at the upper side of this longer term range. And then I think if we look at the longer term, well, it's been an awfully long time since we could say that the FTSE 100 has been able to hold a level at new all-time highs. So obviously then there's a big question. What happens next? Are we going to move into another massive bull market like we had between 1984 and 1999? Or are we going to remain in this just perennially long, volatile, ranging pattern where we make incremental new highs? Well, I think there's one thing that would be interesting then is to think about it not just from how a domestic UK investor looks at the index and instead look at it from the perspective of a global investor. Well, then we can see very clearly that the FTSE 100 was a really attractive place to be if you were an international investor between about 2002 and 2007. And over the intervening decade, it's been just as disappointing for foreign investors as it has been for domestic investors. Well, I think it's important to just highlight that period between 2002 and 2007 because now look at what did the dollar do during that period of time. So I'm going to have to go for more back history here, but we can very clearly see that after 9/11, the USA went on a massive printing spree and spent trillions of dollars on failed wars. And the dollar went from an historic peak. And let's not forget that the US government was running surpluses and the treasury market was in danger of running out of bonds because they were paying down the debt in 1999. Well, fast forward about a decade, and that was a very much distant memory, and the dollar had done nothing but trend downwards. So then let's just think about this from the perspective of the the rest of the world. And I do apologize. I have forgotten the tick I created. But what I want to show you is that there is an easy way to look at how the rest of the world looks. So when we just simply think about how does the rest of the world perform relative to the USA? So I'm taking the MSCI ex-US and relative to the MSCI US. And we can see here that this ratio trended lower for about a decade and then has just popped on the upside over the last 6 months. And this doesn't look like much. To me at least, it looks like a break of trend. And if it were above the 1,000-day moving average, well, then we could be talking about a secular trend break. But what I find most particularly interesting is that between the period of 2002 and 2007, well, the rest of the world, so the MSCI World ex-US, did way better than the US markets. And I think that's most especially important to pay attention to now, because if the dollar does in fact break down and the dollar index starts trading below 100, then there's the very clear possibility that there's going to be a mass exodus of cash from US markets and into the rest of the world. And the UK will be a beneficiary of that because of the low valuation. And then, of course, one of the other things that's really important is that if the dollar goes down, then it means that other currencies go up. It means then that the purchasing power of countries around the world improves relative to the USA. But that's very attractive for big global international companies because then the customers that they're trying to access, well, they suddenly have more money in their pockets. They can afford to buy those premium products. And that was one of the primary factors behind the growth of the middle class between 2002 and 2007. You had rising living standards around the world. You had a better purchasing power for lots of people. One of the biggest issues over the last decade has been that the dollar has been quite firm. It means that any debt that had been taken out was becoming increasingly more difficult to pay because the dollar kept going up. Well, all of that debt becomes easier to pay if the dollar goes down. And then, of course, it isn't just stocks would do better. Well, we have precious metals that are right at the upper side of this long-term range in dollars. But of course, dollars isn't the only currency that people buy gold in. And when we look at gold in pounds, well, it's already broken out and it's consolidating here in a very orderly manner in the region of £1,600. Then let's just think about the euro, and it has also broken out. But what I saw in here today was news that China has been buying for its own international or its own reserves. And in renminbi, gold is on the cusp of breaking up and through the accelerated peak that we saw back in 2020. So gold's appreciating in lots of different currencies. And this is also a reflection of the clear intention of investors to position themselves both for a weaker dollar environment, but then also for people in emerging markets in particular having better purchasing power. And they will then go off and want to buy gold because it has historically been the thing that people want to own most. And then, of course, we have Japan, and this is gold in yen that we're looking at right now. And the Japanese are basically devaluing their currency. And they have a new central banker, and he has basically said that he hasn't a notion of removing their quantitative easing program. And the yen is holding reasonably well against the dollar, but the dollar is not a strong currency. So let's then look at the yen relative to the euro. And against the euro, well, then the euro is breaking higher here. So Japan and Europe, they compete for a lot of the same end markets. You can think about, for example, Volkswagen is competing against Toyota to sell cars. So the relative position of the currency is a really big deciding factor for the competitiveness of those companies. And this type of industrial competitiveness stretches into a large number of different sectors. So Europe's not going to be especially thrilled at the clear reality that Japan are devaluing their currency. So there's obviously then the potential that Europe will be more aggressive in devaluing their currency. Now, during the period of the post-pandemic environment, there's been at least an attempt to try and curtail inflation. And that's mostly been about competitive currency appreciation. Countries have been raising rates to try and stabilize their currencies, to try and bring down inflationary pressures. But as we move into a tighter liquidity environment around the world, then there is the potential that in order to stimulate economic growth, we'll see more competition to devalue currencies. And most particularly when one currency is devaluing faster than others and then damaging the competitiveness of different economies. So that's really what's going to happen is it's going to ignite a currency devaluation trend, and we're only at the beginning of that right now. So there's obviously the potential then that precious metals will appreciate. Ex-US assets will outperform for the lengthy medium term. And then, of course, that's before we even begin to think about offshoring, reshoring, friendshoring, nearshoring, before we start thinking about the the vast quantity of infrastructure that's going to be required to come even remotely close to achieving some of the climate goals that politicians continue to talk about. And all of that's also going to require money. So the logical progression here is that we will go through a period of lower economic growth globally. Then there will be a central bank response, and that central bank response is likely to take the form of enhanced spending, but that spending will come at the expense of the value of the currency. And one of the factors that will contribute then to the performance of hard assets, limited supply assets, will be that devaluation of currencies. And I think with that, I'll leave you for this week and wish all the best to all of you.